Welcome to BT Podcasts. In this episode, find out how we can rethink our wealth and build resilient portfolios. This episode is brought to you by UOB.
Everyone's still talking about the Federal Reserve's 50 basis point rate cut. Stocks hit new record highs again last week, riding the wave of optimism that's come from that cut. And we're recording this at the beginning of October. And some market watchers feel, despite persistent concerns surrounding the durability of growth and interest rate policy, the U.S. economy remains fundamentally strong. Okay, too many words. Here's what we should find out. What to do. Say it with me now. Expert advice, please. Welcome to Podcast by the Business Times. I'm Howie Lim. In this episode, we get insights from Abel Lim, Head of Wealth Management Advisory and Strategy at UOB. Is it time to rethink our wealth? And how do we do that? Abel, thanks for your time.
Hello, Howie. Thank you very much for having me today.
So happy to be speaking to you because this is something we really need to figure out. And at the base of that is risk appetite. We hear a lot about it. How much can you stomach? Can you sleep at night? That sort of thing. Why is it so important to know your risk appetite? And then how do we figure out what your risk appetite is?
You know, Howie, that's a really, really good question. To make things easier to understand, I like to use this analogy. One's appetite for spiciness. So if you understand your risk appetite or your level of spiciness that you can handle when it comes to food, you enjoy the experience a lot better. You actually make better decisions. You will not suffer the aftermath of making a wrong decision. Similarly, you're also better positioned to tell whoever is preparing your food or your portfolio and advise him a lot better on what you are ready to undertake and what you can take as opposed to what is out of your comfort zone. So, spiciness. If you are aware of your spice level, you are able to choose between what kind of food you like and what kind of food you cannot handle. And the chef will be able to prepare your meal a lot better, at least a lot more consistent to your comfort level.
I like this analogy, except for level of spice testing, it's very simple. Stick your finger in the food, put it on your tongue. I can't do it. How do we do that with assets to invest in?
Good question. So understanding your risk appetite allows you to make those better decisions by limiting the emotions that tends to come with investments. When you think about investing, you tend to overreact because we are humans, right? So when we see risk, we tend to head out for the exit door almost immediately. And when everybody's talking about something, we tend to chase that something. This is actually not investing. In fact, this is the absolute opposite from investing. So emotional investing is something which you need to be aware of. It forms part and parcel of your risk appetite. Similarly, financial security plays a very important role. For example, if you are comfortable today, you have a little debt, you have savings, most of your assets are paid up, you tend to be in a better position to consider riskier assets. Similarly, if you have a longer time horizon, you're looking towards a retirement plan, you have time on your side. You're able to allow time to smooth out volatility. So again, you are able to take on higher risks to achieve those longer term goals. In line with that, your life stage. Individuals like a student coming to the workforce for the very first time, you have a lot of time on your side. You are able and capable of taking on higher risk assets to be able to deliver your long-term goals. However, if you are nearing retirement, you won't be so gung-ho out there. You will probably want to consider something that's on the safer end, less volatile, a lot more palatable, that will not give me a bad tummy at the end of the journey.
And this is how we can plan or financially plan accordingly, right? So once we know our risk appetite, it cannot be based on how strong one's stomach is, one's ability to sleep at night, and how mobile the knee is to do knee-jerk reactions. We plan accordingly to, say, life stages and all those other factors that you mentioned.
Absolutely right. We also encourage individuals to consider engaging professionals with well thought up tools that can enable the customer to arrive at the right risk level that he or she is comfortable with. So in UOB, we have many tools like such. In fact, on our Tomorrow app, you're able to assess some of your risk propensity, your appetite, and also your tolerance. Typically, this is some of the key levers that investors out there can leverage upon. Go out there and speak to a professional and get those advice. Also, one of the key factors is to get yourself educated. Financial literacy today is not very
great.
well spoken, unfortunately.
Yeah.
In fact, I still think that it should be a module at least somewhere during our educational system, because it's going to be a lot tougher and harder for our younger generation to invest in the future. So get educated, stay informed, understand what's happening in the market, why it's happening, and how does it impact you. Now, for financial planning, or at least how do you plan according to that, other than understanding your risk, you also need to know how do you invest. In that sense, asset allocation. If I'm conservative, I will not go for the sexier, high-risk equities and the other moving parts that actually can impact my portfolio negatively. I will definitely go for something that's safer, something that's at least stable, consistent, and predictable. In the cash universe, in the fixed income universe, things that are a lot more stable. Of course, when I'm a lot more aggressive, maybe younger, I will undertake a lot more riskier assets. I would definitely want to invest into equities, high risk, high returns, right? Even within the equity space, I'll probably want to go for things that are considered sexier, the emerging market front, more tactical solutions, very sectorial play, very single country plays. Those give significant higher alpha, but at the same time, it also carries similar risk. For a more balanced individual, a 50-50 portfolio would probably do a lot better. Exposure into the equity space with higher qualities, and also exposure into the fixed income space with high quality issuers. So collectively, that helps you plan in your financial journey a lot easier. It's a lot smoother and a lot more predictable.
We're at the stage where inflation is falling gradually. How can we position our portfolios to benefit from this?
So the good news is inflation has been steadily grinding down since the mid of 2022 at its peak. And today, I believe inflation has reached a level where most central banks are comfortable in terms of relooking at their monetary policies. As such, we have seen the first rate cut by the FOMC. This gives us a signal that a new dawn is happening. That now the inflation rate environment is starting to come off. Definitely, the central banks need to react by cutting rates, because high rates will put on a lot of stress on the economy. We encourage customers to think about locking in the high bond yields. And obviously, as rates continue to trend lower, that's going to be beneficial on the capital gains front, because there's an inverse relationship between bond prices and interest rates. We encourage investors to think about buying into high-quality issuers. The high yielders should be taken with a little bit of caution, because when rates are being cut and the economy starts to show some weakness, you don't want to be in the high yield space. Now, next we think about dividend stocks. When rates starts to come off, dividend paying stocks becomes very attractive. This company's robust, strong cash flow, well ran, normally consistent because they are big players in their market. These equities become very attractive to investors. So you'll see a flow towards dividend paying equities stocks in the near term. Last but not least, as rates starts to trend off, the US dollar is likely to continue to weaken. We've already seen it, right? Now, dollar thing is probably about 128.5 today or in that region. And it's likely to continue to trend lower as the Federal Reserve continues to cut their rates. Now, as rates start to fall and as the dollar weakens, emerging markets, Asian equities will be one of the main benefactors or winners in this instance. Why? Because you're going to see fund flows out from the US equities, US fixed income, towards the Asian side, whereby you get better yield pickups, and you also see companies, because of lowering borrowing costs, become a more growth-centric, outperforming the markets in the near term. So these are supportive arguments why falling inflation, falling interest rate is likely to benefit some of these names that I've already mentioned.
Hold that thought. Abel Lim is Head of Wealth Management Advisory and Strategy at UOB. More in a moment.
And now back to BT Podcasts, brought to you by UOB.
We're speaking to Abel Lim from UOB, and we promised to be talking about that 50 basis point rate cut that the Fed did in September, which boosted risk sentiment. The major stock markets are trading at an all-time high. So should we continue to invest or be cautious going forward? Because I did hear you say caution earlier. In what areas and what should we do?
Okay, for the average retail investor, trying to time the market is possibly one of the worst strategy one can employ. Even professional managers tend to get that wrong. So staying in the market is a far superior strategy.
Yeah.
As such, we advise our investors to have long-term goal in place, focus on that long-term goal, and have that strategic allocation in place so that it achieves and delivers that financial objective. Reacting to markets doesn't pay off. In fact, some of the best trading days can be found in the worst market conditions, in bear markets. In fact, 50% of those trading days actually deliver significant returns when markets are in the bear territory. So your average retail investors trying to get out of the peak and trying to buy back in, typically they miss the boat. And when you miss those boats, investors will lose out nearly 50% of the total market gains just by missing 10 of the best trading days. So trying to time the market hasn't really paid off in a very big way. Similarly, we think about dollar cost averaging. We do not know where the peak is. We do not know when market corrects. We do not know where the bottom is. Adopt dollar cost averaging, i.e. buy consistently at a similar amount. So over time, you will be able to average out everything to the lowest possible dollar cost average. As prices go up, your portfolio gains. As prices come down, you buy things cheaper. So ultimately, dollar cost averaging affords you the best possible average cost over the long run. Now think about having some dry powder. You never know when the opportunities offers and presents themselves. So when market corrects, you should deploy some of this excess cash to buy bargains. We all love bargains. When things are cheaper, for example, I won't use a name, but a big semiconductor name prices falls off the cliff. Why not own some of that? Because if you believe in the business model, you believe in the macros behind it, and you believe that the company will continue to generate significant earnings growth, you should pick up some of these bargains. And market corrections are normal. Mean revision is normal. So don't expect a market to continually head up north without any form of correction. There will be profit taking, there will be corrections, and be comfortable with it because this is part and parcel of investing. Time will smooth out those volatility. So if you allow sufficient time in a portfolio, have a long-term objective in mind, focusing on the long-term goals, you actually will not be negatively impacted.
What about things that happen in the world that might affect markets, say geopolitical tension, conflicts and all that rising, right? So there's uncertainty. That word always likes to be bandied about, although I feel like markets are always volatile. Markets are always uncertain. Come on. What are the ways to build then a resilient investment portfolio, Abel?
Here's the good news. Market events like such conflicts, they typically have a very temporary effect on equity markets. Investors should be focusing on earnings and the wider spectrum because this is where you deliver the outcome that you so desire. If you think about it, the current conflict in the Middle East, in Europe, a lot of this news has already been baked in. An escalation, of course, will have impact. For example, we are looking at oil prices starting to shift in the last couple of days. These will have impact. But again, these are shorter term in nature, and over time, this will dissipate. So reacting negatively to this news tend to be detrimental to any investors. In fact, think about diversification. Diversification affords an investor the luxury of participating in various assets across different sectors, different geography. So this allows you to be able to mitigate some of the negative losses in particular sector, maybe in the equity space, but this will be mitigated by gains in certain asset classes that tend to outperform during times of uncertainty and in times of conflicts. So a diversified portfolio holds up a lot better during times of uncertainty and volatility. So we encourage investors to think about spreading your eggs so that you do not end up having a concentration risk and having to suffer huge losses. Think about safe haven assets as well, precious metal and commodities and real assets, things that have real tangible value. And again, hold cash. Conflicts, the natural reaction for a human being is to get out of the market right now, wait for things to settle. This means discounts are coming. You want to get into those spaces. And with dry powder, extra cash on the side, you'll be able to participate in some of these opportunities and be able to ride the recovery.
Okay. How often should we rebalance our portfolios? Because current market environment is such, it won't always be the same.
That's a question we have debated quite a fair bit. In the past, the average rebalancing cycle is about 12 months.
Yeah.
That should be sufficient. But today, things are a lot more volatile.
I'm not looking at it every day, Abel. I cannot.
Oh, no, don't look at it every day. That'd be a terrible way to invest. Then obviously you're having the wrong risk appetite. You invested wrongly. I would expect an average 6 months review. I think that's a reasonable time because it allows time for the markets to perform and to deliver an outcome. And through that process, you understand whether you're on track or whether you need a certain level of tweaking. Maintaining a targeted asset allocation is going to be quite important because that gives you an objective, the guardrails of how you want to achieve your longer term goals. And these things do change. Market evolves, prices move. And at the end of the day, you will want to be able to ensure that you're still within those guardrails. If you have spilled out of these guardrails, how do you get back on track? So you need to understand where your targeted long-term asset allocation is likely to be. Risk management, again, is also going to be quite important because we age, lifestyle changes, circumstances in our life changes. For example, a newborn baby, a promotion, a change of job roles. All this will have impact on how your portfolio should be structured because your goals have shifted. And you need to be aware of this. And the financial advisor needs to be aware of this so that they can restructure that portfolio, rebalance to make it relevant to your current position and your longer term needs. As you age, our risk level will tend to decrease. Not all. Some people, I know people who are in the elderly stage who are still very aggressive in their portfolio. But typically, the advice is as you age, you should be shifting your portfolio from riskier assets like equities towards safer assets like fixed income and cash because these are a lot more certain and more stable. Why? When you're younger, you can afford to sum up a lot more risk. But over time, equity markets tend to trend upwards and deliver an alpha. So you have time on your side. As you approach your retirement age, you can no longer exchange human capital for a salary. You cannot take that risk. Last but not least, of course, you want to consider market conditions and how things have evolved and how it's likely to affect your portfolio. It's going to have a huge impetus on how you balance your portfolio. So in UOB, we think about asset allocation through a core and tactical approach. Now, the core approach is not about building a portfolio of global bonds and global equities. It's about building a portfolio that's consistent, that's not tempted by market movements, but pays an income. Passive income is going to be an incredibly important tool when you retire. You can consistently build passive income today so that when you reach retirement, it continues to pay you. So that core portfolio is robust, stable, and it needs to be consistently worked upon. Tactical solutions, these are the ones that which are...
Scare people?
Well, I won't say scare, but I think these are the ones that give you outsized returns, but at the same time carries outsized risk. You will want to be careful in this space. So we have a very strong investment committee that identifies this potentials investment. I articulated Asia just now. That's one of our key calls. Investors should participate and can participate to deliver an additional returns over your typical portfolio, beating inflation, beating cash rates. So tactical and a core solution actually works very well for investors, and the rebalancing can actually happen within that. Think about reducing your tactical allocation towards a more consistent core portfolio because over time, you want stability, you want consistency, you want predictability. So ultimately, that is what our core and tactical approach is designed and meant to deliver.
Sound advice from Abel Lim, Head of Wealth Management Advisory and Strategy at UOB. Abel, thank you for your time.
The pleasure's all mine. Thank you.
I'm Howie Lim. This has been BT Podcasts from the Business Times.
This episode of BT Podcasts was brought to you by UOB. Find more BT Podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.